What'd you miss? When it comes to stock picking, thinking long pays dividends. Jay Bowen, who is CEO of Bowen, Haynes & Company, spoke with our Julie Hyman about his company's approach to investing.
So we call ourselves unconventionally conventional. It's nothing fancy. It's actually a little bit boring, but because of what's transpired in the industry, particularly over the last 25 years, we are seen as somewhat of a relic. And when I say unconventionally conventional, it's a very high quality, long-term approach with an emphasis on common stocks. And it's a top-down thematic approach where we're trying to get ahead of different themes and allocate the assets accordingly. I think the most unique thing about the approach and why they've been so successful is that it's a 20-year investment approach. They actually, the board...
That's your time horizon.
And the pension fund actually embraces a 20-year approach. And the reason they use a 20-year approach, we did a study several years ago, and we determined that there has not been a 20-year period in our financial history that hadn't included a bull market, that has not included a bull market and a bear market and a recession and a speculative bubble and a war. So it's a great way to measure the total, in all different market situations and circumstances, the total performance of a manager. The other intriguing thing about the 20-year approach, we look back to 1928, and we looked at every 20-year rolling period going back to 1928, and there's 71 different 20-year segments. The average return for common stocks during those 71 20-year rolling periods is over 11%. It's just over 11%. So that gave us, that really, I think, validated our approach to emphasize common stocks, number one, and number two, to take the 20-year approach. And then the third component, I think, of why they've been so successful is fees, relatively low fees, when you compare it to other funds in the arena, other public funds, which, by the way, depending on the study you look at, some estimates are saying that there's a $5 trillion unfunded liability crisis. And so I think what we've done in Tampa is somewhat unique.
I am curious what your top holdings are right now and how often, you know, if you have this 20-year investing horizon, how often are you looking for new ideas, new investments, as opposed to building up, say, the positions you have or just changing them on the margins?
Right. Well, you know, it depends on the top-down work we're doing. We're very focused on economic policies, particularly on the monetary side. Monetary policy, fiscal policy, tax and regulatory policy, trade policy. That really drives. We really start by answering really broad questions in terms of, are common stocks relatively attractive relative to other asset classes? And then number two, where do we want to be from a sector and industry standpoint? So
are common stocks attractive right now, given all of that?
We think they are. It's a tricky period, and the two big questions we're asking right now is, we're 10 years into this economic expansion and bull market. We just started the 10th year. So is it realistic to think that we can undergo an economic rejuvenation 10 years in to this recovery? Number one. Number two, can the Fed engineer this tightening cycle without inverting the yield curve? And we would answer in the affirmative to both of those for a variety of reasons. I mean, on the fiscal side, I think these policy reforms that are being implemented, particularly on the tax and regulatory side, are going to really re-incentivize the economy from an output, employment, and production standpoint. So I think you have a situation of rejuvenation of capital spending and business fixed investment, which could drive productivity higher. You know, we've really been lacking on the productivity side. It used to routinely grow at 2%. We've been at less than half that for a while. So we think we could be on the front end of a capital spending boom because of these policy reforms, which means growth would trend back.
Even given the threat of tariffs and a potential trade war, how do you factor that in?
Yeah, you know, on that front, I think we're a little bit different in that I think that might end up leading to freer trade, possibly. I mean,
if it works.
If it works, and it's a gamble, but I really think that the post-World War II General Agreement on Trade and Tariffs and WTO successor, that model is over now. I just think it's over, where you have these large multinational 1,000-page deals that are driven by corporate interests, which frankly, they're replete with problems in terms of addressing non-tariff barriers, in terms of addressing currency manipulation, in terms of addressing intellectual property issues, technology transfer issues. There are a lot of problems with these large deals. For instance, the TPP negotiations, I talked to somebody who was involved with those. None of those issues were addressed. So I think the TPP is the old model. The new model is the South Korean model, which was just successfully renegotiated, bilateral. So I think we're moving from multilateral, which has some problems, which has been great in the post-World War II era, but I think now it's time to move on to the next era, which I think is going to be bilateral, as represented by the South Korean deal.
And that was Julie Hyman talking with Bowen, Haynes and Company CEO Jay Bowen. Now